Hey coconuts, welcome back to another episode of Stock Geek Out. Today we have Tim, right, the head of content and investment lead at ProsperUs. We are here to talk about a awesome stock. It's called Brookfield Infrastructure Partners. Don't worry, I also have not heard about it. So Tim's here to explain a little bit more what this is about and why it's a good play, if it even is a good play, right? And he has, over 10 years of investment in content experience. A little bit more about him with the likes of Schroders and Motley Fool, covering everything from US stock markets to Asian equities and multi-asset. He's a passionate advocate of educating investors on the benefits of long-term investing and how to find the best-in-class structural growth stories amid fast-moving world. Tim's also a certified trainer for the SGX Academy. Welcome, Tim.
Thank you, Rakesh. Yeah, good to be back. Hopefully, I can shed a bit more light on Brookfield Infra for you and the listeners.
Definitely, you know me and tech, so this is definitely not tech. So
this is the opposite of tech. Yeah, this is like real assets, like not digital.
And in all fairness, we should be talking about these sort of assets now, right?
Yeah.
Because let's be honest, my portfolio is crap. I am not diversified whatsoever. So
I think this would be a good opportunity to kind of, I guess, in this environment where everything tech is just being hammered, I think it might be a good idea for every listeners and anyone who's not diversified to think about ways that they can diversify their portfolio. Because obviously, finding yourself, I mean, I'm also 50-60% in tech, so it was pretty painful, right. With the drawdown, right? Okay. So, but I think thankfully there have been other areas of the portfolio for me that have helped buffer that. So I think this is a good reminder in this drawdown of, the importance of diversification.
Gotcha.
Yeah.
Gotcha. Yeah. I mean, that's a good one. Okay, let's get into Brookfield Infrastructure Partners. All right,
let's do it.
What are they?
Okay, so basically, Brookfield Infrastructure is a infrastructure company that owns multiple assets across different verticals. These mainly come under four segments, right? Utilities, transportation, midstream energy, which basically it means like natural gas and like gas liquid pipelines, and data, which would include sort of like your data centers and telecom towers, right? So an example would be, assets that they own and operate include like 7.3 million electricity and natural gas connections, over 30,000 kilometers of rail operations, 13 terminals, like port terminals, over 3,800 kilometers of toll roads, and 17 natural gas and liquid processing plants, And then on the data center side, they have about 50 data centers and over 160,000 telecom towers. So they basically are, I think first and foremost, they're not really a utility. I think people would think that they're more of a utility looking at their asset base. But what they do is they are first and foremost a capital allocator, capital recycler. So they look for opportunities to buy underperforming assets or cheap assets, which they think they can then turn around and, generate a high like internal rate of return out of, and then sell on. And then they'll recycle the capital they get from asset sales, to buy assets where they think they can deliver a higher return from.
Okay, so they're effectively a bit like thinking of it this way. They're almost like a PE fund, right? I'm gonna get something that I'm gonna make more money out of. It's not doing so well.
Yeah.
So I'm gonna effectively make it better, sell it, take the gains, and then
rinse, repeat. Yeah, but in the infrastructure world, basically owning the real assets of the economy, things that make it tick, as I've just explained, sort of data centers, rail cargo, toll roads. And so they are global in nature. I mean, they get about 40. So if you think about revenue from a normal, a normal stock or a normal company like a Microsoft or a Google or a Facebook or whatever, for infrastructure companies, it's more based on funds from operations, which is what are they, what's the cash that they're generating from the assets that they own, right?
Got it.
And so in terms of the FFO, that's the shorthand name for FFO, funds from operations.
Okay.
They generate about 44% from North America. So that includes obviously the US and Canada.
Right.
And then they have about 20% each in South America, Europe, and Asia Pacific. So they are quite diversified in that sense. So they have on the ground teams in every region. They're very, very, meticulous in terms of how they go through deals.
Okay.
And the key for them is they have a track record that backs it up, right? So it went public in 2009. It's sort of outperformed the S&P on an annualized basis since then over the past 13 years. So it's generated a return of about 19% annualized total return versus the S&P 500's 11%.
Got it.
And in terms of the distribution, they obviously obviously also pay a dividend. So this is another reason why I like this stock. It's a little bit different in terms of it owns an asset, but then it spits off the cash to distribute out to unit holders. And it's grown that dividend at a CAGR of about 10% over the past 13 years. So in terms of, the track record, I think it's there. It's not your dividend aristocrats that have been, delivering dividends for 50 years, but that was only because it went public. So like 2008, 2009. But, they have managed to deliver outsized returns over their lifespan so far. And so they have a very, very good reputation. And they're 27% owned by Brookfield Asset Management, which is obviously the asset manager based out of Canada. And so a lot of their top management actually has a lot of experience either working within Brookfield itself, and then moving on to the infrastructure side. And so they benefit a lot from actually having a lot of connections with other institutional investors. So they, on certain deals, will go in with, with specialized investors. For example, they bought some data centers in South America back in 2019. And they did a JV with Digital Realty, which is obviously, as you know, one of the biggest data center operators in the world. And so I think that kind of speaks to their reputation among, investors as well as asset owners. People know them. They've got a great reputation for risk management, obviously delivering returns that they do. And so people want to partner with them and people are willing to partner with them. So I think they benefit a lot from that. And that in itself is mainly a function of the scale they have. They've just got massive scale.
Got it. We were talking about infrastructure, but it's not necessarily always just about roads and train lines and all of that. Like what you just mentioned with data centers.
Data centers, right.
And so they're actually moving a little bit more into where this growth is going to
be. Exactly. So actually management describes themselves as a growtility. It's a bit cringy. But effectively what that means is, obviously there's that growth that you have, but with the utility-like attributes, that are defensive, right? If there is a recession, this is always quoted as one of the names that is recession resistant or recession proof. I mean, no company is really recession proof effectively, but things will still need to be transported. There's still increased demand for data. There's still increased, demand for gas pipelines because there's a squeeze on investment. So there's not enough supply. So I think even if there is a recession, one of these, the Brookfield infrastructures of the world will probably find opportunities to pick up cheap assets because they've got the scale and they've got the liquidity to buy on the cheap. But then again, on the flip side, that could be hard for them to offload assets that they don't want to own anymore. So I think there's a few ways of looking at it. But I think, overall, if you're looking at a recession or if you're looking at a hard time for the global economy, owning real assets, via Brookfield infrastructure, I think is one of the best ways to set up a defensive tilt to your portfolio.
Got it. So let's dive down a little deeper here, right?
Yeah.
So we have the growtility.
Growtility, right? With the growth potential as well, right? Yeah.
Okay. But we're not obviously talking about big, massive spikes in growth here, right?
No.
We're talking about infrastructure.
Yeah, infrastructure, right.
One of the things that you mentioned was the fact that during the recession, technically, and more so now, you mentioned data is important.
Yeah.
Increasingly important.
Yeah.
But also supply chain is massive. It's almost a commodity.
Yeah.
Right.
Yeah, exactly.
We've seen what Redmart and Lazada is doing to us, charging us extra money for this
delivery,
right? Yeah, exactly.
Booking slots, right?
Exactly.
Yeah.
So, ships are becoming more expensive, gas pipelines, all that needs to be built, roads need to be built. So you would then see that the angle that they're going to play.
Yeah.
The slow, long game.
Exactly. So this is one of those that is, in a way, just like the renewable energy transition, this is something that is going to continue to be in demand over the next 10, 20, 30 years. You see all those studies. There was that World Bank study saying by 2040, there needs to be something like, 30 trillion in investment into infrastructure globally. Asia itself it needs about 10 to 15, trillion by 2030 or 40. So this is something that is going to continue to build just because, as you said, there's been underinvestment, at least in the West, for a long time in investment infrastructure. And that's starting to catch up with the economies. And so there's really a need for these types of assets. And the owners of these types of assets are going to have much more pricing power, right? Because there's such a scarcity of quality assets that they can charge, right? So I think it's more the fact that Brookfield is scouring the globe looking for the best investments in the infrastructure space. the highest quality assets and then trying to, work with partners or either go in with Brookfield Asset Management or by themselves to acquire these assets and then really deliver a superior return for investors. But I think part of it is also, gas pipelines for them is actually quite a big portion of their business. But ESG now is huge, right? So all these groups, Brookfield and obviously BlackRock, they're all talking about ESG. So when you think about Brookfield Infra, they're thinking about natural gas as the bridge energy between oil and coal towards renewables, right? Because renewables right now, they only make up something like 10%, I think, of total energy generation globally. And so there's still a long road ahead of them, but there's just not enough supply of that coming online, right? So natural gas, there are LNG terminals, in Qatar, in Asia, in the West Coast and East Coast of the US. So these guys are becoming more important players in that energy transition. And so I think Brookfield really eyes an opportunity there. The whole war with Ukraine, right? Russia, Ukraine, I think it really highlighted the fact that there's obviously way too much dependence on Russia for oil and gas. But secondly, they need to diversify for energy security. And so now they're looking at exporting gas, LNG from the US East Coast. I think there was a deal signed between the US and, European EU to try and improve that flow of natural gas from the US. And at the end of the day, who's going to benefit, right? A lot of these asset owners that are going to be shipping this. And obviously Brookfield Infrastructure is going to be one of those players. So there's still investment into natural gas, into LNG. It may not be the cleanest fuel, but there's demand, as we look at oil, there's still oil. Look at all the energy players this year, right? So it's been an interesting trend to watch, but I think this is a trend that will play out over 5, 10, 20 years.
It's good to see that they're also moving towards softer assets like, data centers and so on and so forth. So let's dive down into the management bit, right? Because that shift for me is important.
Yeah.
And as we do in Stock Geek Outs, we try and understand the motivation behind the management. Firstly, are they capable? Are they going to keep growing?
Growing, yeah.
Whichever, right?
Right.
Are they going to pivot the company, expand the company?
Yeah.
Tell us a bit more about them.
Okay, so, founder-led, I think when we invest in individual stocks, one of the keys that a lot of investors say is, is it founder-led? And if it's not founder-led, then maybe it's not worth investing in. But I think when you look at asset owners and infrastructure, it's a totally different game to something like a SaaS, play, right? That is asset light and you're a complete startup. These guys own assets that are worth billions and billions of dollars, and they have to operate them, and they have to have a professional team in place to do that. And so these guys at Brookfield are top notch in terms of their experience. The BIP CIO, Brookfield Infrastructure CEO rather, is Sam Pollock, and he's been with Brookfield since '94. He had previous roles as Chief Investment Officer at Brookfield itself, Brookfield Asset Management, and he also worked within the corporate investment and private equity businesses at Brookfield. And so he's been CEO of Brookfield since 2006. So there's some continuity there. He knows the business very well. It's been about 15.
So he brought it to IPO, actually.
Yeah, he actually brought it to IPO. So it's been about 16 years now as CEO. So he's there. He knows the business very, very well. 20 managing partners within the team, about 22 years experience overall average, and 14 years with Brookfield among those 20 managing partners. And I think they have about 2,300 corporates, like execs as well working for them. So there's a massive team of expertise there. And what they have is they have the backing of Brookfield Asset Management as well, which I think is that soft power that isn't really tangible maybe, but it lends itself to the company being able to leverage the Brookfield name to get, lower cost of funding, partnerships with other asset owners that want to buy in or invest. And so there's a lot of cachet, I think, attached to that, to have the backing of Brookfield Asset Management and the size that and sort of scale that they have, because they can raise money at lower rates. They can issue equity, and so they actually have been issuing equity, shares wise, to raise money. But the key is that diluting returns, and is that diluting sort of the payout and the DPS, and it's not at all. It's actually been growing, as I said, about 10% with the payout, right? And the total return of the shares is as I mentioned, has beaten the S&P.
Wow.